You're listening to the Big Cast, your source for the latest in financial technology. Brought to you weekly by the Best Innovation Group, with your hosts, John Best and Glenn Sarvati.
Welcome to another edition of the Big Cast. My name is Glenn Sarvati on behalf of the Best Innovation Group, where we like to do cool things with financial technology, with a particular focus on credit unions. And today we're going to be speaking with Andrew Gomez of Payloom, who I caught up with. I talked to him quite a bit out at the Nacha Payments Conference a couple of weeks ago, but we caught up to record after the fact to really kind of pull back the covers on the whole notion of pay by bank, which was one of the hottest topics, I would say, that kind of dominated the agenda. Along with a lot of other interesting stuff going on with lots of various changes going on in the credit union space and the payment space overall. Want to remind you, you can always find out more about the Best Innovation Group by checking out our website, big-fintech.com. Let's do our usual kind of spin through the week's events before we jump into the interview. This is the latest breaking one. I'm reserving my judgment, but right now, current signs are actually looking up with regard to the status of the credit union tax exemption. I'm actually going to quote directly from the CU Daily. First off, I'll just say that their piece on this starts by saying, in a victory for credit unions, the tax package that will begin markup tomorrow in the House Ways and Means Committee does not include revoking the credit union tax exemption. So that's a direct quote from the article. I'm not going to go as far as calling it a credit union, a victory rather, but I am going to call it a positive sign. We have just seen way too much going on that shows that these winds can shift really unpredictably very quickly over the course of the last several months. So obviously feel good about it, but I'm not going to say that this is by any means a done deal. Our friend Jason Sturrock, the Chief Advocacy Officer of the Defense Credit Union Council, I'll quote him directly from that same article. Nowhere in the bill is there any reference to credit unions, federal credit unions, or 501c14 tax-exempt entities. There are no proposed changes to the Internal Revenue Code that would affect credit union tax-exempt status, nor does the bill introduce other business income tax provisions or modifications to NCUA oversight. In other words, credit unions just are kind of, at this point, not even in the mix. At the other side of the process, we know this bill is not complete. They're still trying to rush to get it out, like literally still over 2 months from now. So there's a long road ahead. Amendments can obviously change that. But as I say, it's a good sign right now. My basic view is don't get too high, don't get too low, don't get distracted by things that you can't control. But don't let up on your voice on this one either. I thought it was interesting, too, that over the course of this process, there was a lot of fresh debate that came up, including on our own CU Town Hall last week. And there's a link to that. If you go to cutownhall.com, you can listen back to a debate about just how important is that tax exemption to the true credit union difference and exactly what would it mean. Would it literally be a death knell for the credit union movement? Kind of a divided world on that one in terms of what people are thinking. But I think the whole debate about how we differentiate ourselves, regardless of how this turns out, is going to turn out to have been very valuable. So again, if you're interested, cutownhall.com. Another piece of news this week, and another one that ties into our bingo card. Jonathan McKernan is now apparently going to accept a role or be nominated to a role in the Treasury Department, which means he is out at the CFPB. That will be the fourth leadership change of the CFPB since the Trump inauguration. At this point, I'm not exactly sure what that job entails, since they've basically shut down the organization for all intents and purposes. They've attempted to furlough 85% of the employees. That's actually tangled up in the courts right now, so we'll see what exactly the person who's going to be appointed to run the CFPB is actually running. But another thing around that topic as well, one of the CFPB rulings, the final rule that came out around Section 1033 and open banking at the very end of the Rohit Chopra era late last year, looked for a while like it was actually not going to be touched and may just kind of continue apace. And it did seem like it had pretty good bipartisan support. Well, that's no longer the case either. Like I say, the winds change quickly around here. They are now, actually, I don't know if it's officially been done, but there has been widespread reporting that the CFPB plans to reopen that rule, to reassess some aspects of it. There's even been some speculation they may vacate the rule because there is a court case brought by the Bank Policy Institute against it. And when you consider that there's really nobody left at the CFPB, they may not try to defend themselves, which might get the rule just flat out thrown out. Who the heck knows at this point? But it's an interesting one. I think that most credit unions would say, okay, there were some issues with that rule around open banking, particularly around data privacy, data security, and the ability to recoup costs that it takes to create a portal to share that information. So I think there would be some tweaking that would be very welcome. My personal view is whether or not open banking is mandated, it's something that people ought to be looking at because it's going to become a competitive piece of the landscape in terms of how we work with the larger and stack up against the larger institutions. Watch this space, but we'll post a couple links to those so you can understand exactly what we're talking about there. And as I mentioned earlier, our bingo card of things that might be happening this year, we checked that one off a long time ago around the CFPB having new leadership. We can't put 4 checks on it, but we effectively probably should. Another one that we can check off is naming rights, more naming rights for sports stadiums with credit unions. These are pretty cool ones. This one was actually a bit, and again, we've checked this off. The L&N Credit Union, Federal Credit Union, has the naming rights for the University of Louisville's football stadium. That actually happened back in January, but we're just kind of catching up on this one. And it's an interesting one because the L&N Federal Credit Union is now community chartered. Originally was part of the L&N Railroad. That was the employee base they served when they were fielded membership around an employer. And the L&N Railroad used to most of their offices were directly at the location where the University of Football Stadium now sits. So kind of an interesting full circle there. Another one that just came up, BQ, which is obviously very involved with very high visibility in the Pacific Northwest, has now taken on the naming rights for the Seattle Storm of the WNBA, their practice facility. And again, that one's a really deep partnership that I think is interesting because part of that partnership was that the BQ actually financed the construction of that facility. So a nice virtuous circle on that one. Again, we checked that one off on the bingo card. Back to the outcomes of the Nacha Payments Conference, which we'll post a link last week. We already did a couple of interviews related to that. A lot of great, interesting content there. But I'd say the single biggest topic that was on the agenda was Pay by Bank, which is, as you'll hear, is kind of a clunky and not terribly precise term. And it means some different things to different people, and I think people are kind of at different minds of where it's going. The Fiserv relationship with Walmart to roll it out at that big box retailer is probably the most visible example of it here in the States. But we caught up with our friend Andrew Gomez, who we've spoken to before, who I think has a great perspective on this stuff, both from his work in the U.S. and on the Pay by Bank Task Force, which is underway right now, but also his perspective from living overseas for 15 years, where some of this stuff is kind of everyday occurrence at this point. So let's have a listen to my conversation with Andrew Gomez. I'm here with Andrew Gomez, Senior Advisor for Payloom. Actually, I've known Andrew from before those days. He was a very busy man at Nacha Payments, 4 different presentations, I think, over a 4-day stretch, Andrew, if I'm not mistaken. Wanted to talk to you specifically. I guess that wasn't the only thing you talked about, but Pay by Bank was very prominent, I think, on the overall agenda, the topics people are really focused on. And you did a couple of really good sessions and one that kind of just laid out the landscape. And that's where I really wanted to pick your brain. So thanks for agreeing to take the time from Berlin, Germany.
Yeah, my pleasure, Glenn. Thanks for having me.
So tell us, Payloom, with the banner you fly under, what is Payloom? You're an advisory firm, correct?
Correct. So we're a Belgium-based payments consultancy. I'm actually based in Berlin, but I've got colleagues in Brussels, London, Madrid, I think Amsterdam as well. So we're kind of we're distributed throughout Western Europe, let's say. I tend to focus on the training, education, and payment strategy side of the business. But I also have colleagues that work on digital modernization. So they help the banks figure out what kind of technology they need, make sure that they're still compliant with the new changes going on. And that's both within Europe, of course, but also outside of Europe. So we do a lot of work in North America. I'm actually leading the Nacha Pay by Bank project team.
I didn't realize you actually chaired that task force. So that even makes this an even better source to kind of get into it. And we're not doing video for this, but I see, obviously, you can tell from Andrew's accent, he is not originally from the European Union. And I see the Golden State Warriors and Oakland Athletics paraphernalia behind him. So he's a Bay Area native. So let's just start into pay by bank. I thought you kind of framed it very nicely at the beginning of the conversation. It's, kind of a clunky term. How do you define, and there is not one official definition, is maybe after you guys do this task force, there will be. Well, how do you define pay by bank?
Yeah, and that's actually a really good point because that's actually one of our key tasks is to kind of come up with a common definition that the American market can start using because you're right, there is no one definition. Um, I would argue, and this is something we're working on with the project team under the Nacha Alliance, is that there are three, let's say, key components of pay by bank. First is that they're inherently electronic, right? So it's not a check, even if you end up digitizing that check and cashing it through one of these check cashing apps, or maybe your bank does it for you. That's not a pay by bank solution. And neither, of course,
that may be mobile or it may be online, but it's digital in some fashion.
Exactly, exactly. The other one is that it uses account credentials to make the payment. So this is maybe where consumers get a little bit lost. When you use Apple Pay or Google Pay, for example, usually it's going to be using, or I think exclusively, it's going to be using stored card credentials, right? So there's a PAN attached, there's an expiration date, there's the CVV code, things like that. When we say pay by bank, we literally mean the account number and routing details. It's not, or in Europe, for example, it'll be based on the IBAN, the international bank account number standard that we use. So it's using the actual account. It's not using something like, say, a card credentials to initiate a transaction. And I think the third aspect that I think is really important is that pay by bank is not tied to a specific system. So it could be over the instant payments, right, rails, whether that's FedNow or RTP, but it doesn't have to be. Same day ACH also can be pay by bank. The normal ACH can also be pay by bank. So the main thing is that it's electronic, it's using an account. Whether it goes over same day ACH or RTP doesn't exclude it from being a pay by bank transaction.
Interesting point that you make there, both what pay by bank is and isn't, because I think that's one of the keys is anything that runs over the debit or credit rails, card rails, is not pay by bank, even though technically you're paying by your bank. I mean, but that's not what we're talking about here, which is why the term's a little bit clunky. And I think we talked about at this stage of the game, I mean, it's primarily the classic ACH rails. It's not even same day is usually what people are looking at this stage of the game. Is that fair to say?
Yeah, I think if you looked at the transaction volume, the vast majority of pay by bank transactions will be going over the standard ACH rails. And that's both, it could be on the ACH credit side or on the debit side. There again, if you look at the numbers, the debit side is going to be far, far larger than the credit side. But again, it doesn't have to be an ACH debit. It could also be an ACH credit.
That makes sense. We also talked a bit about and again, to the extent that the term pay by bank is being used as a product, it's primarily being marketed to the merchants because they're the ones that have to really kind of initiate this process. There isn't a brand name per se. Do you think that at some point there could be like a Venmo, Zelle, PayPal kind of name that might kind of get this crystallized in the consumer's mindset to get them more comfortable with what we're talking about?
Yeah, I think that's a really good question. So, given the size and relatively decentralized nature of the U.S. market, you know, the U.S. is not a small country like, say, the Netherlands or Spain or even, Germany or Italy, let alone any of the other smaller markets in, say, Southeast Europe, like Thailand would be a good example. You're not going to have a single market-wide system that, 95% of people use, or I should say 95% of adults use. The US is just not going to work that way. That said, I don't think that's a bad thing. First, I think generally speaking, competition is always better than not having competition. but also there are plenty of international examples that demonstrate that having multiple different systems can actually be a good thing as long as there's interoperability between those systems. I think the obvious answer here is UPI in India, where you have lots and lots of P2P apps that are connected to the system. And then you can also use those P2P apps to make e-commerce purchases. So you can use it for non-pay by bank, right? Sending friends money to friends or family. But then you can also make purchases for a pair of shoes or pay for your taxi ride or pay for your gardener or whatever, and babysitter, things like that. So I would argue that the US is never going to have a single app for everything, just given the size of the market. But I also don't think that has to be a hindrance. It can be, but it doesn't have to be. And maybe I'll break that down a little bit. There are markets where that has caused a problem, where fragmentation has led or stalled adoption. I think the obvious markets here are Italy and France. There were multiple competing apps that basically just led to a decrease in utility to the point where they're just not used very much.
And were those apps launched by particular specific retailers or fintech companies looking to market the app, or who was competing there?
Yeah, so in the Italian case, there was a company called Bancomat, and Bancomat is the Italian ATM network.
Okay.
I'm so used to saying ACH all the time. I just automatically say
Well, you're coming off
ACH.
the New Orleans conference. No surprise
There
there.
you go. Yeah, so it's so Bancomat is basically the Italian ATM network, and they launched a system. And then there's a fintech competing with them called Satispay. And so those two have been competing with one another, and it's led to, I would argue, lackluster results. You had something similar in France. There was an app called LibPay, LYB Pay, and then, or no, sorry, LifePay, sorry, LifePay and PayLib were the two apps there. And so they competed, and now a third one has entered the market soon. It's called Wero, Wero, which is meant to be a pan-European solution. So we see in these markets where market fragmentation has led to depressed adoption.
And has it started to resolve itself, or are you still kind of in that kind of wait and see attitude now because everybody's kind of churning?
Yeah, so it's really interesting. So Wero kind of came in, and the French banks basically said, "Okay, we're going to go with Wero."
Okay.
They invested in this solution, and it's active nominally in the Netherlands, France, and Germany. There was an acquisition there of some of the local systems, and now it's being rolled out in France and Germany. It's still too early to say how much of a success it's going to be. In Italy, they've kind of taken the opposite approach, where Bancomat Pay has joined, let's call it a Southern European coalition, along with the providers in Portugal and Spain, to launch their own kind of competing network against Wero. So here we have like regional agglomerations of payment apps. But I think another option, and this is something we've seen in Scandinavia, is where market fragmentation actually led to aggregation. So what happened was MobilePay in Denmark ended up swallowing up its smaller competitors. It then moved over into Finland and took over another competitor there. Same thing in Norway. So MobilePay and Vipps in Norway joined forces. So now there's like one Scandinavian app, which excludes actually Sweden, which funnily enough is the largest Scandinavian market.
Yeah.
So there's some competing things there. So you have a couple different examples that are the complete opposite effect. And then again, I would also point out to UPI in India or the systems in Thailand. So PromptPay is the name of the system in Thailand, and it basically embeds within the mobile app within the banks, and therefore while there is a common name, like PromptPay is a name, the users don't necessarily use PromptPay. They're using their bank, which uses the PromptPay network. So I don't think
no one's saying prompt pay me. That's not the way people think about it. It's just, hey, I'm paying by my bank.
Yeah, exactly. Although I do think there is some acknowledgement that prompt pay is kind of powering the network. I mean, if you think about UPI in India, interestingly enough, this is a brand that's gotten so strong that every Indian actually knows UPI in the same way that, I mean, I'm not sure you can imagine all Americans knowing what EPN was or RTP or FedNow.
Great point. Great point. And UPI is actually run by the Indian Central Bank, correct?
Not quite. It's operated, it was set up and operated by NPCI, the National Payments Corporation of India.
Which is a
Um,
consortium of the banks, or what is that?
yeah, it's kind of a combination of NACHA in the sense of it's a rulemaking body, but it's also an operator on its own. And it's not a government organization, but it works closely with the Indian government.
So it's interesting because, at least to my mind, the first real serious push in the States on this, you're talking about in most other countries that the banks have had some kind of more direct play in it. Right now, it seems like the test case on a scale basis seems to be Walmart working with Fiserv. And because obviously a big box retailer having that kind of overall kind of market saturation can make the push for this kind of thing. So it seems like it's kind of coming at it from the other angle in the States. Am I thinking about that correctly?
No, I would completely agree with you. And it makes sense, right? Because the US is just such a massive market. You know, there are a couple of big box retailers, right? Walmart's the obvious example there. Target would be another one where, you know, there's stores that are all over the US. Every American knows what Walmart is. Same thing with Target. Um, they have the clout to kind of organize and to create proprietary apps that their customers will use.
And they'll be
Um,
embedded. I mean, there's already a Walmart app. Presumably, it's not a separate app. It will be embedded within the Walmart app.
yeah, exactly. So, I mean, in fact, I would even say it shouldn't be a different app. It
Right.
needs to be integrated into that Walmart app to not confuse consumers. Um, I would also argue that it's the bigger retailers who have the clout that can kind of move the American market in that direction. The amount of I don't want to guess how much money Walmart pays every year to the card schemes,
Yeah.
right? In terms of acquiring fees. If you compare that to a mom and pop store, you know, I don't know, a small hardware store or a painting supply store, you know, that's night and day in terms of their capabilities.
And let's come back to that in a second, because I think that's one of the questions of the big retailers versus the mom and pops in terms of getting the scale on this one. But one of the questions that came, a couple of things that kind of came to my mind. Somebody mentioned on the call or in your session, and when we opened up to Q&A, why would a consumer want to do this? I mean, if they're comfortable using their cards, I think rewards would be one obvious answer. If the retailer can offer their own rewards program and they can control the rewards as opposed to letting the card network control the rewards. You made a really great point. There are some people who just don't like credit cards.
Yeah, I think that's really important. And I would also argue that not only do some people just not like credit cards, it's the younger people. Um, that's where we see an increased trend in card aversion, let's say.
And does that card
Now,
aversion go beyond just credit into debit cards as well? Because I mean, again, you could make the argument still, if a consumer wants to use their debit card, they're kind of acclimated to that already.
yeah, I think that's true. However, I think it's the same people that tend to use their debit cards because they don't want to build up a debt from a credit card. If you make it convenient, they'd be happy to use their bank account too, because essentially with a debit card, that's what they are doing, right? It's going over the
Exactly.
card network.
And the other thing there, as we were just talking about before, debit transactions rarely are accompanied with rewards. But if the merchant wants to put rewards on top of this, then obviously it's actually better than a debit card from the consumer standpoint, arguably.
Yeah, and I think another key factor here is the user experience, right? So, for example, I'll use the example that I when I order food to food delivery. I have my bank account embedded within that platform. So when I choose my food, I hit the pay, um, I click on pay with my bank account. I authenticate myself with a thumbprint or with my facial recognition, and the transaction happens.
Mhm.
So Now, you can obviously do that, something similar to that with a card. But if I'm setting something up in Europe, I have no problem giving my account information out to people. Why? Because if you have my IBAN, good luck. All you can do with it is send me money. So, you know,
Yeah.
feel free to do that. But whereas if I give out my card credentials, those can be hacked. There are ways around multi-factor authentication, right? You can manipulate my email address. You can figure out other things. Whereas with my bank account, all you can do is send me money.
Now,
So
that's where it gets interesting in the States, right? Because you have the debit capability in the ACH network. And I mean, one of the things that we talked about is, as in terms of getting this set up, people are still fixated, I wouldn't say fixated, but acclimated to the check paradigm. You look to the check to get your RTN and your DDA account number, and that's how you fill things out. You also make the point that is not necessarily the case here. You don't have to do that because there might be a Plaid or somebody that authenticates you.
exactly. So one of the things that I really like about the combination of open banking and let's say pay by bank principles is that I'm able to use an API to click on my bank. I then log myself in and then I approve the payment. And now maybe I'm using a payment initiation service provider to initiate a credit transfer or maybe an instant credit transfer, or maybe I'm authenticating myself for a debit transaction. As a consumer, I don't actually care which one it is. Um, from a merchant's perspective, they tend to prefer debits, and that's because they get notifications about when that a transaction has happened. Whereas if I'm just pushing money, they have to then do some reconciliation there to figure out, okay, he wanted to buy a pair of shoes. Do we see the matching account payment for that transaction? Whereas with a debit, it's more seamless and integrated.
Interesting.
Um, yeah, but I would argue that this is where we see directories and the importance of directories. And a quick shout out to Peter Tapling and the U.S. Faster Payments Council, the Directory Models Work Group, which I'm also a member of. What we like to talk about is how a directory can really facilitate things by pay by bank, not just pay by bank, but other things as well. And the reason for that is, I'm pretty sure that you've memorized your email address or your cell phone number. The vast majority of Americans do not know what their account number or routing number is by heart, right? But they all know their phone number or their email address. And furthermore, they have no qualms about giving that out, right? There are very few instances where people do not feel comfortable giving out an email address. Maybe they won't want to give out a phone number because they don't want to get phone calls. They don't want to get, text messages. But an email address is about as inconspicuous as it gets.
And that's
Um,
also,
and
I
the,
mean, that's one of the magics of Zelle, right? They did that around either email or your cell phone number, which is probably getting as close to a national ID as we're going to get in the States.
yeah, and that I would argue is a bit of a shame actually, because increasingly as our lives become more digital, we need a way to digitally authenticate and authorize transactions that we're making. And I think in many markets, the creation of a digital ID can go a long way to securing our finances. Whether it's something like Bank ID in Sweden or the equivalent in Denmark, whose name I've now forgotten. I mean, even in Germany, my residence permit also functions as an ID and can also be used digitally online. So I can use the chip reader in my phone, hook it up to my residence card, and then I can authenticate myself for online transactions if I wanted to.
So the things that still kind of come back to me, and I guess it's different in Europe or a lot of other countries because card interchange is not nearly as big a piece of the revenue equation, the way banks operate. In the States, we talked already about why would a consumer want to do this. I guess the other kind of half of the devil's advocate question is, why would an FI want to do this? If we can get, everybody loves interchange from a bank standpoint. If you're the issuer, assuming you are the issuer, which is not necessarily the bank where you hold your account, debit interchange obviously much lower, but there's still a revenue stream. If you move here, aren't you cannibalizing additional revenue yet again?
I think you could make that argument, but I think we can make that argument with almost any technology, right? Car manufacturers created electric cars, right? It took them a long time and there was a big push, but they ended up doing that. And by having to create electric engines, they had to forego decades of research and optimization in terms of gasoline engines. Um, when it comes to cell phones, for example, almost everyone nowadays utilizes a standard cell phone plan that gives you unlimited minutes, unlimited data, and they no longer charge you for long distance phone calls, right? I mean, I remember as a kid, you didn't make long distance phone calls unless you needed to. That's not an issue anymore. And I would argue probably anyone under the age of 25 has no idea what a long distance phone call is.
Right, right.
So this is all to say, I think there's a broader trend that we're having to modernize. We're having to make sure, as a financial services industry, that we meet our customers where they want to be. Because if we don't, someone else will.
That's a very fair point.
And I think that's really important because interchange is one part of the revenue stream of a bank, but it's not the only one. And I would argue that enabling your consumers or your merchant customers to accept pay by bank or make pay by bank transactions, will you forego some interchange? Yeah, you will, but you're still going to become relevant and you're going to deepen that relationship with your customer. And if you don't do this, there are customers that will eventually look somewhere else. And if I'm servicing a merchant, the merchant clearly wants to accept this payment type. If I don't offer them that, they will switch banks to someone who will, because for them, it really is dollars and cents per transaction that they're losing. So I think, should banks be in love with this? Maybe not. It's going to require them to go back to the drawing board to rethink how they've done things. But if you want to stay relevant into the 21st century, it's clear to me you're going to have to do this. And pay by bank isn't a theoretical thing that could happen at some point in the future. It's already happening. So now we're talking about, to what degree is it happening? How many transactions are happening? How many merchants are accepting it? It's not about whether this will happen at some point. It already is happening.
Would you agree with me? Am I forgetting any other good examples? To me, the watch this space kind of metric from a test case in the States is this Fiserv Walmart partnership or alliance, whatever you want to call it. Is there anything else to that level that you would say will be a real kind of proving ground of whether it gains the traction?
So I think some of the other big players would be like, the Plaids of the world, the Trustleys. They're also helping their merchants make pay by bank transactions. I mean, they're doing other things besides pay by bank as well. So I think those are some other players. I'm trying to think of other examples. I mean, you could even argue to a certain extent, someone like PayPal I wouldn't really call PayPal pay by bank per se. Um, but it's clearly demonstrating the power of the UX and not just the user experience, but also the ease of transaction, the convenience of, I've stored my credentials, I hit pay, I authenticated myself, the transaction happened.
And I think that's a great example. I remember that was another question that came from the audience when you opened it up, someone said, isn't this kind of what PayPal's doing? And the one thought I have is, again, going back to the original definition, and a lot of that is still running on card rails. So that's one of the reasons it isn't, but it's yet another example of a non-bank that's actually getting involved in this mix. So I think it kind of proves your other point as well. While you were visiting here, you probably saw their marketing campaign around Will Ferrell here is massive. I mean, it's ubiquitous. You can't miss the commercial. I don't know how much they're spending on this campaign.
Yeah, and what's interesting with PayPal is, so I mean, I use PayPal all the time in Germany because we don't really have a market dominant app. That said, my PayPal is actually tied to my bank account. So PayPal can facilitate pay by
Yes.
bank. I would argue it's not necessarily a pay by bank solution, but it can be used. So whenever I use PayPal, it initiates a debit off of my account.
That's a really good point. I haven't really looked closely lately if they've stepped up their efforts. I know they try to get you to move it over to the bank account. I don't know. I'm sure the data's out there someplace in terms of what percentage of the transactions are running card rails versus ACH, et cetera. The one other thing that I just want to touch on quickly before we wrap up is we talked already before. Obviously, Walmart's got the scale, Target's got the scale, any of the big grocers, I think, and they clearly have motivation to try to move things to lower cost of acceptance. When we did talk about a little bit the mom and pops, the flower shops, the paint shops, the whatever the folks on Main Street are, since they can't all have their apps. I mean, you've mentioned before in Europe, you've actually have some more kind of aggregation processes. UPI works that way too. Are you thinking that's just further down the road in the States, or how did these smaller ones without that kind of critical mass participate in this wave?
Yeah, so I think the complicating factor for them is just the lack of clout that they have when it comes to negotiating better terms. And I think we're going to see a range of responses here.
Mhm.
There's going to be some mom and pop stores that are, where someone really is going to be savvy about this and investigate what are their different options, and they're going to ask their acquirer processor, hey, what are these different options and how does this look, and why maybe they're not going to go for a bundled solution where you just accept all payment types and it costs you whatever it costs. Then there are going to be some people who say, you know what, I have better things to do with my time. This isn't important enough for me to worry about this. So I don't think there's a one size fits all solution here. And let me give you a perfect example. When I had a guy come over and help me with renovations in my apartment, he asked me to pay, I think it was 20% of the total fees up front. And this was a man, by the way, who's retired, right? He's
Okay.
not a young person.
Yeah.
He said to me, please use the instant payment system to pay me the 20% fee so I can go buy materials and get started. And I was shocked. This was a guy who was pushing 70, um, who asked for an instant payment so that he could start doing some renovation work on my apartment.
Well, it's a perfect use case too, because one of the reasons people want the money up front is for working capital. He's not going to front the money to actually get all the materials. Makes sense.
Exactly.
Andrew, I always love these conversations. It's always fascinating to pick your brain on this stuff. If people want to find out more, I mean, I know that you've kind of got a couple of different company names, but depending on where you are in different parts of the European Union, maybe your LinkedIn webpage may be the best place to go.
Yeah, I think if you just go onto LinkedIn and look for R. Andrew Gomez, you'll find me. I don't think there are too many of us running around on LinkedIn, at least not in the payment space.
Well, I will post I'll include a link to that in our show notes as well. Andrew Gomez, Senior Advisor for Paylim. Thanks so much.
Thank you.
So kind of an additional piece of the puzzle we didn't really get into is, as Andrew said in his definition, and I think most definitions, we tend to default toward ACH in thinking about the way Pay by Bank would likely work. But it doesn't have to be ACH. Well, there's, the same day ACH, which is just a different flavor, or it could be the variety of instant payments, RTP, FedNow, and things like that. As we've talked about before, and there was a session specifically about the instant payment use case of Pay by Bank. To this day, instant payments has increasing traction, but it's almost entirely on the B2B side and also on the account to account side. I think the providers would quibble with me that there is consumer volume, and that is true, especially on the account to account side. But frankly, I've not seen the necessary use case, the breakthrough use case that's really going to get things going on the consumer side. And that was one of the conversations, is just how fast and how important is it that money moves instantaneously in the consumer use cases. And that's going to be interesting to follow. Personally, I know that I'd feel better if I heard another kind of use case being positioned as, hey, look, this is why this is important. I must have heard it 5 times at Nacha. Sports gambling, online sports gambling. That's a case where you want instant payments because obviously, A, you can't do it on credit card, and B, the folks, the bookie, for lack of a better term, wants to know that they absolutely can't have that payment revoked once the bet doesn't come through. I'd like to see a little bit more of a vanilla. I don't know. I don't want to use a too pejorative a term on sports gambling, but I'd rather see it being used for some other constructive purpose before I got too excited about it. Anyway, there's still more I'd like to talk about with regard to Nacha, and we may indeed do that. Who knows? There was also a really great Finovate last week out in San Diego, which I didn't get to, but some familiar names, including our friends out at Illuma Labs, took away best of show. We'll be maybe doing some catch up on that. I've got a couple colleagues who are out there watching the events, and maybe reaching out to them to catch their impressions. You can always find out more in the meantime and the past conversations that we have had by checking out the Best Innovation Group website, big-fintech.com. Troll around there and find all the other interesting things that the Best Innovation Group has going on, particularly in the AI space. I think deserves a lot of attention these days. But you can click on the media tab and find out a lot more about what's been going on and the folks that we've been talking to in the recent past. You can also find us on Spotify, Apple Podcasts, Amazon Music, wherever you get your podcasts. We appreciate if you'd click so they automatically get delivered to you, so you can remember that we usually have new content, almost always every Tuesday, fresh content. And we'll be doing that again next week, as I say. My name is Glenn Sarvati. You can track us down on LinkedIn, my firm, 154 Advisors. You can find the Best Innovation Group on LinkedIn, as well as our Grand Poobah, John Best. We're also posting regularly on Blue Sky these days, including our Friday FinTech 5, where we try to kind of curate what we think are some of the most interesting stories without paywalls that can kind of keep you up to date on what we think has been going on, not just in the credit union space, but in financial technology more broadly. With that, another episode of the Big Cast in the books. Again, my name is Glenn Sarvati, and thanks again for listening.
Check back each week for the latest from the Big Cast. Or better yet, we hope you'll consider subscribing for free via Spotify, Stitcher, Apple, or wherever you get your podcasts. If you have questions or comments, we'd love to hear from you. Tweet us at Big FinTech. Email info@big-fintech.com. Or visit us at big-fintech.com and click on the Media tab, where you can post a comment or check out our archive of hundreds of past episodes. See you next week.